Thank you, Klaus, and thank you for the invitation to speak at this workshop, which I have been attending since its very beginning in 2004. Something that I love about this conference that has kept me coming back almost every year is its tradition of open inquiry and even some fun on the one hand, combined with rigorous critical analysis on the other. I am a supporter, and I guess a practitioner, of rigorous criticism, because as you may have heard, the conference award given each year for Outstanding Critic was named after me. And based on that standard I set, the person who wins the award is also known as the most annoying participant. I suppose it was only karma that a guy like me who likes to dish out criticism would end up in a job that receives plenty of it. Kidding aside, I do consider being the namesake for this award a great honor, and just to make sure my head doesn't get too big about it, the conference organizers purposefully misspelled my name on the award. My subject today is the outlook for the US economy and the Federal Reserve's ongoing campaign to bring down inflation and achieve our 2% inflation objective. There are three takeaways from my speech today. First, inflation is far too high, and it is too soon to say whether inflation is moving meaningfully and persistently downward. The Federal Open Market Committee, or FOMC, is committed to undertake actions to bring inflation back down to our 2% target. This is a fight we cannot and will not walk away from. The second takeaway is that the fears of a recession starting in the first half of this year have faded away, and the robust US labor market is giving us the flexibility to be aggressive in our fight against inflation. For that reason, I support continued increases in the FOMC's policy rate, and based on what I know as of today, I support a significant increase at our next meeting on September 20th and 21st to get the policy rate to a setting that is clearly restricting demand. The final takeaway is that I believe forward guidance is becoming less useful at this stage of the tightening cycle. Future decisions on the size of additional rate increases and the destination for the policy rate in this cycle should be solely determined by the incoming data and their implications for economic activity, employment, and inflation. Based on all the data that we have received since the FOMC's last meeting, I believe the policy decision at our next meeting will be straightforward. Because of the strong labor market right now, there is no trade-off between the Fed's employment and inflation objectives. So we will continue to aggressively fight inflation. Inflation is widespread, driven by strong demand that has only begun to moderate, by an ongoing lag in labor force participation, and by supply chain problems that may be improving in some areas, but are still considerable. For these reasons, I expect it will take some time before inflation moves back to our 2% goal, and that the FOMC will be tightening policy into 2023. But the answers to questions of how high and for how long will depend solely on incoming data. Since I spoke last July, I think the argument that we entered a recession in the first half of 2022 has pretty much ended. We didn't. With each passing week, the absence of any indication of a recession in spending or employment data just buries this recession argument a little deeper. We understand some of the factors that lowered the gross domestic product or GDP numbers in the first half, and a debate continues about other possible factors, such as mismeasurement, potentially underreporting GDP. What we can say is after the Fed telegraphed its policy pivot to tightening in the latter months of 2021 and began raising rates in the fourth quarter of this year, demand and economic activity slowed in the first half of 2022 from the strong pace of 2021. Data suggests an uptick in consumption growth in the third quarter. Meanwhile, the Atlanta Fed's GDP Now model forecasts real GDP will grow 2.6% this quarter, although other estimates may be a touch below that. Spending data are supportive of continued expansion. Nominal retail sales overall were flat in July, but that is mainly because falling gasoline and auto prices, which is good news, held back sales in those sectors. Excluding those two categories, retail sales rose 0.7%, suggesting that discretionary spending grew solidly. Businesses also continued to expand production and spending. Total industrial production increased 0.6% in July, standing 3.9% above its level a year ago. Forward-looking indicators of manufacturing activities, such as new orders indices in various manufacturing surveys, are softer than earlier in the year, but most, and in particular the positive August reading from the ISM, are not suggestive of a material pullback in manufacturing activity. Meanwhile, the non-manufacturing ISM report suggests continuing growth, with its new orders index rising to a solid level last month. But there are some signs of moderation in economic activity, which is what the FOMC is trying to achieve by tightening monetary policy. Not surprisingly, higher interest rates this year are slowing activity in the housing market. There have been declines in construction of single-family homes for a number of months, with permits and home starts both decreasing in July. Sales of existing and new single-family homes have also slowed. Existing home sales fell by 5.9% to a seasonally adjusted annual rate of 4.8 million homes in July. While the imbalance between housing supply and demand remains significant, it has meaningfully improved. The inventory of unsold new and existing homes has more than doubled since January. While the 3-month supply of existing homes is still below levels that existed before the pandemic, the 11 months of new home inventory is the highest since the spring of 2009. This latter statistic has raised concerns by some about a significant downturn looming in the housing market. But an important caveat is that much of the current elevated inventory reflects the recent low rate of housing completion due to continued supply constraints. Many of these new homes for sale are still under construction, and as supply constraints ease, builders will be able to deliver more completed homes to a market where the supply of existing homes remains tight. All that said, the housing market is a significant channel for monetary policy, and I'll be watching this sector carefully. The FOMC's goal is that the tightening in monetary policy slows aggregate demand so that it is in better alignment with supply across all sectors of the economy. My expectation is that strong household savings, the tight labor market, and additional availability of manufactured goods as supply chain strains continue to resolve will allow households to make long-awaited purchases, which will provide a partial offset to tighter policy. That will support a slowing rather than a contraction in aggregate demand. Turning to the very strong labor market, private payroll employment has been increasing at an average of nearly 400,000 jobs a month over the last several months. Unemployment rose 0.2% in August to 3.7%, in part reflecting an increase in the labor force participation rate, but still stands at a very low level. The increase in participation was welcome news, but this rate is still far below that achieved before the pandemic, when unemployment was roughly as low as it is today. We are facing worker shortages in many sectors of the economy. Job openings have started to decline a little bit, but remain very elevated. These data confirm that the Fed is hitting its full employment mandate, so all my attention is focused on bringing inflation down. Now, inflation slowed in July, which is a very encouraging development. Headline inflation for both the Consumer Price Index and the index derived from personal consumption expenditures, or the PCE index, which is the Fed's preferred measure, slowed largely due to continuing declines in prices for gasoline and other petroleum products. Excluding volatile energy and food prices, core inflation for these two indices also stepped down from rapid increases of earlier this year. But it's still too early to say that inflation is moving meaningfully and persistently downward. And inflation is still widespread. For both headline and core inflation, at least 60% of the underlying categories of different goods and services increased by 3% or more. Prices for housing services are elevated and still rising. Core goods inflation continues to run well above its pre-pandemic level. Inflation for services, excluding housing, has moved up this past year, in part due to consumers shifting back to more normal activities outside the household as social distancing has eased. Looking ahead, I will be focusing on a number of factors that will influence inflation. On housing services, rent, and the so-called owner's equivalent rent, I expect to see sizable increases in this component of inflation for a while, as the recent rise in new rentals makes its way into aggregate price measures. In a speech I gave in March, I noted that based on various measures of asking rents, some analysts were predicting that the rate of rent inflation in the Consumer Price Index could double in 2022. And so far, it is on pace to more than double. Owner's equivalent rent is similarly on pace to nearly double this year. So sometime early next year, though, I expect to see the upward pressure on inflation from these forces to ease as future increases in new or renewed leases moderate and the full effects of monetary policy tightening make their way to housing services prices. Beyond housing, I expect goods price inflation to continue to moderate as monetary policy now and going forward slows the paces of increase in aggregate demand, supply problems ease, and supply and demand come into better balance. There is some evidence that goods supply, production, and delivery problems tied to the pandemic are improving, with supplier delivery times and reports of items in short supply continuing to drop. In terms of service price inflation, we saw a step down in airfares and other travel-related services last month. But I am uncertain how these services, as well as food services and non-market service prices, will evolve going forward. Nominal wages have been growing quickly, and I'll be watching closely to see how wage growth evolves and feeds into inflation. The Atlanta Fed's wage growth tracker hit another record in July for its 24 years of data, with a 12-month rate of 6.7% wage growth. I don't expect wage increases to ease up much unless and until there's a significant softening in the labor market. Now, one way to anticipate future wage growth is through quit rates. Now, most people who quit their jobs are moving to other jobs. They're not moving typically into unemployment, and they pay significantly higher. So we're seeing a lot of wage pressure coming from job to job transitions. So once quits start easing and coming down, that will take some pressure off wage growth from that perspective. So quits are near their highest level over the 22 years that the government has tracked them, but they have come down from the start of the year. And further decreases would bring them closer to the level they were at immediately before the pandemic, when wages were growing much more slowly than today. Another factor that I'll be watching closely is longer-term inflation expectations, which I believe significantly influence inflation. As inflation moved higher over the past year and a half, measures of short-term inflation expectations moved up noticeably. But measures of longer-term expectations rose only a little and generally stand near levels seen in the years before the pandemic, when inflation was low. In fact, several measures of longer-term inflation expectations have edged lower over the past couple of months. To me, this means that the public retains confidence that the Fed will be able to rein in inflation in the medium term. To sum up, while I welcome promising news about inflation, I don't yet see convincing evidence that it is moving meaningfully and persistently down along a trajectory to reach our 2% target. I keep in mind a year ago, we saw similar promising evidence of inflation moderating for several months before it blew up and jumped up to a high and then very high level. Those earlier inflation readings probably delayed our pivot to tightening monetary policy by a few months. The consequences of being fooled by a temporary softening in inflation could be even greater now if another misjudgment damages the Fed's credibility. So until I see a meaningful and persistent moderation of the rise in core prices, I will support taking significant further steps to tighten monetary policy. Now let me lay out the implications of this economic outlook for monetary policy. Since March, the FOMC has raised our policy target range from near zero to between 2.25% and 2.5%. That puts the upper bound of the current target range at the median of FOMC participants' longer run projection for the policy rate, as recorded in the June Summary of Economic Projections, or SEP. This long run rate is effectively where participants think the policy rate would settle when the economy is growing at potential and inflation is at our 2% target. This is a good definition of success when employment and inflation are near our goals and no help is needed from monetary policy. But that's not where we're at now. Inflation is far from our goal, so more action is needed. The policy rate will have to move meaningfully above this neutral level to further restrain aggregate demand and put more downward pressure on prices. Looking ahead to our next meeting, I support another significant increase in the policy rate. But looking further out, I can't tell you about the appropriate path of policy. The peak range and how fast we will move there will depend on the data we receive about the economy. Earlier this year, when we were ending asset purchases, inflation was quite elevated and we were lifting the target range off the effective lower bound. So it made sense at that time to provide forward guidance to help convey the urgency the FOMC felt about tightening monetary policy. Forward guidance was useful in helping the public understand how quickly we expected to tighten. And we saw longer-term interest rates move up quite rapidly as a result of these communications. And additional hikes should lead to further restraint in aggregate demand. As we continue to raise rates, we need to see month by month how households and businesses are adjusting to the tighter financial conditions and how that adjustment is affecting inflation. We shouldn't be estimating what the peak level of the target range will be and how quickly we will get there, because those details are much more dependent on the economic data now than it was in the case when the only direction for the Fed funds rate was to go up, and by a lot. This is not to suggest that I anticipate rate increases stopping very soon. I expect that getting inflation to fall meaningfully and persistently toward our 2% target will require increases in the target range for the federal funds rate into at least early next year. But don't ask me about the policy path because I truly don't know. It'll depend on the data. 6 months ago, I would not have thought we would be where we are today, with inflation far from our target after significantly tightening policy much faster than we anticipated back in March, and with shrinking of our large balance sheet. Now, there are a range of possibilities for how the economy will perform, however, and we can talk about the implications of that range for policy. Say, for example, inflation follows the path laid out in the June SEP, which has core PCE inflation falling to 4.3% in the fourth quarter of 2022 and moving toward 2% over 23 and 24. In that case, I would support our policy rate peaking near 4%. But based on the experience of the past year and a half, it would be foolish to express great confidence that this plausible path will come to pass. Instead, it is important to consider the range of possibilities and the appropriate policy responses. For example, if inflation does not moderate the second half of this year or even rises further, then in my view, the policy rate will probably need to move well above 4%. Alternatively, if inflation suddenly decelerates, then in my mind, the policy rate might peak at less than 4%. One thing that is more predictable and has significant effect on tightening policy over time is the shrinking of the Fed's holdings of assets. as maturing securities run off our balance sheet. Starting this month, the Fed is shedding $60 billion a month in Treasury securities and up to $35 billion a month in agency mortgage-backed securities. This action effectively increases the supply of securities in the hands of private investors and will thus put upward pressure on interest rates, as private investors must now be enticed to hold these assets. All told, the FOMC has taken unprecedented and decisive policy actions this year to quickly increase the policy rate in response to high inflation. But where we stand now is not good enough. Although the labor market is strong, inflation is too elevated. So I support another significant hike in 2 weeks. After that, the tightening path will continue until we see clear and convincing evidence that inflation is moving down to our 2% target. The pace of tightening is uncertain, and it will depend on the data. No matter what, I'm ready and willing to do what it takes to bring inflation down. Thank you. So now the good stuff, Q&A.
Okay, thank you very much. So we have some time for questions. So either from online or from the floor, please. But wait a little bit, you have to take the microphone.
Hi, Monica.
Okay, thank you, Chris, for this very insightful speech. While I'm listening to you, I'm sitting here and wondering, so what on earth went wrong during these last 2 years? About 2 years ago, when we, or if we had met here in Vienna, we would have listened to papers, academic papers with a kind of question, oh, what about this missing inflation? Why isn't there enough inflation? So here we are 2 years later, talking about inflation rates having reached close to 10%, both in the United States, also in the euro area. So what on earth went wrong? Was it that policymakers were not alert? Were they fully asleep, or were they clinging to the wrong models, models that are no good? So what on earth went wrong?
Right, so I gave a speech at the Hoover Institute earlier this year where I kind of went back and looked at the 2021 and the policy response and kind of what was driving policy. When inflation took off in basically March and April of 2021, all of the factors that people were looking at were all basically level effect changes in prices. None of this was permanent. And so everybody thought, well, there might be adjustment as you get to the new level, but this should all be, and I'm going to say the dreaded word, transitory. Okay, and so that was what everybody thought. It wasn't just us, forecasters, everybody had this view that, these are pretty much level effects. These aren't permanent effects to the long run inflation rate. And if you looked at the data, this is what I pointed out in the speech, if you looked at the inflation data last year, from April through September, the monthly inflation prints were coming down. So the whole transitory story was holding together until October. And in September, the monthly print was like 0.25. And then in October, it was 0.8. And then November was 0.9, I believe. So it just exploded at that point. And that's when we pivoted. So I would say that, and I've said this before, I would say that one of the mistakes we made is that from a risk management point of view, we should have been saying, what if this isn't transitory? What if this actually lasts a lot longer? Then risk management would say you need to start tightening now to give yourself policy space down the road if you need it. So we didn't, I think, and this is just my view, not my colleagues, I'm not throwing any stones at anybody, just, but it's that. We probably should have started tapering sooner so that we could have got it done sooner and we could have lifted off sooner. So that's where I think. We're still trying to see if, in fact, inflation is going to be embedded in inflation expectations. That's when it becomes a problem. And that's where we're trying to really go after it and tackle it now. We do not want inflation expectations to get unanchored.
Hi, Chris. Thank you very much for this very insightful presentation. We are in Europe, and European imports into the US is about 15%. How important is the slow reaction of the European Central Bank and the increasing interest rate differential between the euro area and the US And how much does it help the US in your economic policy?
You know, that's in terms of what other central banks do, I typically don't comment on other central banks' policy because I don't want them commenting on what I do. So, I mean, ECB, I mean, look, they raised the policy rate 75 basis points yesterday. So they're moving way faster than anybody thought they would even move in June, you know, just barely over 2 months ago. A lot of this, the typical argument for central banking is if these things are all supply type shocks, you just kind of have to let them hit. Because if you try to offset the inflation, you're going to cause a recession and hurt unemployment. If you try to deal with the recession effects from these negative shocks, you're just going to get even worse inflation. So kind of the rule of thumb often in central banking is as much as you dislike it, you just have to take what happens when you get supply shocks. So I think that's kind of where the assessment of maybe the ECB was that these are supply shocks. We can't really do much about it, so we should just let them hit. The problem is there's lots of reasons that could lead to unanchoring of inflation expectations. So even this idea that, it's a supply shock, we can't do much about it, if that thing persists and goes in, now it is your problem. So this is, I think, one of the things that has changed a lot with kind of more modern policy approaches is that this is the key thing you have to worry on is keeping inflation expectations anchored. And there can be lots of things that start to de-anchor. So even though you normally would say don't respond to these types of shocks, now you say, look, we may have to just to keep this from happening.
So there, you just pointed out that there are several leading economic indicators pointing downwards, but then yet on the other hand, the GDP nowcast of Atlanta, Fed is, you said 2.6, something like this. Isn't that a little bit puzzling? You're just at the starting point of.
Yes, I'm sorry, I'm having a hard time hearing. Is the mic on?
Okay, is it on? Okay. You just pointed out that there are several leading economic indicators pointing downwards, but yet on the other hand, the Atlanta nowcast is at 2.6. I think you said. How isn't that a little bit puzzling for you? How can we interpret these data? We are just at the start of doing our forecast exercise here.
Right. So the first half of this year, and I'm not going to rehash old speeches that I gave, but there's this puzzling problem with the GDP numbers. So GDP fell something like 1.6% in the first quarter and 1.4% in the second quarter, which those numbers are kind of being revised now. But gross domestic income, which these two things should be equal from accounting, it grew at exactly the opposite amount. So you've got GDP going down roughly 3%, and you have gross domestic income growing at over 3%. So whenever that happens, the statistical agencies have a problem. Somehow these numbers have to be the same in any coherent structure. Now they have different surveys, they get the data from different sources, so they don't always match. So when we've seen this in the past, and I believe the last time it may have happened was around 2014, you can check that, but the agencies these numbers tend to get pulled back together, which would mean GDP is going to get revised up. So what looks like at first glance, kind of a recession or near recession in the first half, is probably later going to be revised upward. This is one of the problems with policymaking in real time. I don't get to wait till next year when they do the revisions to make my decision for policy today. So that's why this has been a really puzzling period. You looked at the US labor market during this period, the first half of the year. We added over 3 million jobs and GDP went down. What are these people doing? I mean, it just doesn't square. So that was kind of where everybody was. And then once we got the July employment report with over 500,000 jobs created, it just killed this whole argument. Nobody's looking at it now. And whatever it is, we're now seeing higher, positive growth rates for the second half of the year, not necessarily like last year, which was over 6%, but getting more in line with the more kind of longer term trends. We still think we have to have growth below trend to kind of get enough pressure on the economy to get prices down. So we'll keep an eye on it.
Questions online?
Yes. Hello, Chris. My name is David Andolfato. I'll be moderating the online questions. There's a couple of questions. I don't think they're unexpected. I'll ask them both because they're related, though they're slightly different. So Greg Robb of MarketWatch asks, Hi, could you define significant? Both
That's your job, Greg.
50 and 75 basis point moves in that basket. And a related question by Nick Timireos of the Wall Street Journal. He asked, market participants currently anticipate a rate increase of 75 basis points in September. When you say that the decision will be straightforward and that you support another significant increase in September, is it fair to infer that you mean you think the market is properly anticipating your next move?
Again, Nick, it's your job to infer, not mine. I know what I'm thinking about doing, but you have to figure out what the words mean.
Right, weak answers. Thank you.
Hey, Chris, it's great to see you again.
Hey.
Thanks for joining us. I wanted to ask you about worker shortages and labor shortages,
Yep.
which is something that has been discussed a lot in policy circles. What extent do you believe recent labor shortages are responsible for inflation, recent inflation dynamics? And to the extent that labor shortages are more acute in terms of personal service and low wage occupations, to what extent do you believe future monetary policy actions will impact those wage dynamics?
Yes, so the labor force participation rate, it's lower than it was, but I believe I'm going to say this correctly, but Stephanie Aronson at Jackson Hole gave a presentation. And if you look at labor force participation compared to where it was predicted to be starting in, if you forecast forward from about 2000, it's pretty much right on target. So we've known that this was going to be falling for 20 years, okay? I would say that the thing that was in all this that's missing is immigration. Immigration has basically kind of come to a stop in the US. And if you had just taken immigration trends going forward, I believe this number is, somebody can check it, but we would be down off that trend about 2.5 million workers. And a lot of those workers would be, in fact, in the leisure and hospitality sector. So I think one of the biggest factors driving the labor shortage is immigration. I'm not saying policies are good or bad, it's just we're down about that many jobs from what the trend would have been.
Could I ask a question related to these labor shortages? So you mentioned a lot of vacancies also being an indicator of this, but JOLTS, for instance, has like vacancies that are way off the charts, right? And so I guess the question is kind of how to interpret that. Like, do you see that just as labor shortage, or is more necessary to understand like a JOLTS figure now?
Yeah, I mean, that's kind of a great question. You know, I've heard all kinds of explanations. They're fake ads. There's really not there, but pretty much every employer I've talked to said, no, they're real. We know we're posting them for a reason. We're not just throwing up there for something to do. I guess the thing is, you know, this year we're staring at, you know, GDP growth below trend, probably 2% or less, which normally in the past would not be associated with job vacancies of 7.5%. So I mean, this is just the strangest labor market I've seen probably in my professional career. So it's not that the economy is booming at 6 or 7%, which you might say that would justify maybe a 7%, 7.5% vacancy rate, but it's projected to be it. So to me, that's telling you this has all got to be on the labor shortage side. They're posting vacancies that they just can't get filled because of the labor shortage.
Something happening online?
From Pedro de Costa. And he asked a question. I think you touched on it, Chris. Pedro asked, what is your current sense of where rates are likely to peak, and how long of a pause do you envision once you get those levels?
Yeah, that was the whole point of my discussion on forward guidance, that this is all going to depend on the data, right? And particularly inflation data. You know, if it comes in kind of as expected, as I said, I could see rates peaking somewhere around 4%. If inflation doesn't come back down or pops back up, that's what it happened to us last year. We were going down, 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 and then boom, it explodes. Well, if that happens, rates are going to have to go higher than 4%. And if we get a sudden supply chain thing, then it'll be below.
Could I ask a follow-up with Pedro's question? Maybe you've said also, you've alluded to your belief in data dependency in the policy rate. And you mentioned that you'd have to see inflation come down meaningfully and persistently. You emphasized that a number of times. Again, what can you put some numbers on, like what that means?
Well, meaningfully would be if you saw for the next, say, 5-6 months, core PCE and core CPI. I look at both, even though PC is our head. I like to look at CPI because that index is more accurate for lower income households. They spend a much greater share of their income on housing, food, and energy than the typical upper and middle class household. So I look at both for that reason. You have follow-up, David? Oh, okay.
I have another question.
Oh, okay. So if you know, PCE core was printing at about 0.3 of a monthly for months and months and months, and then it shot up to 0.6 in July. Now, if it comes back down to 0.3 and stays there, we're not making any progress, basically. It's staying at 0.3, which is about a 4% annual inflation rate. So if that doesn't start coming down, we're not making progress. That's how I'm interpreting the core PCE monthly print numbers. If that number starts drifting down into the mid to lower 2s, then it's telling me that, and that keeps going, we're headed into a point where inflation is going to start coming in at closer to a number under 3%. But I'd have to see that for months. I got burned last year. We all did. And we're very cautious about getting burned again. So it's got to be a real permanent, longer term decline than like what happened last year.
So I have a question from Jeff Cox of CNBC. Jeff asks, what would be an acceptable increase in the unemployment rate before it would tell you the Fed needs to reverse course and begin loosening policy?
Yeah, that's going to be the tough decision. Like I said in the speech, right now we're not facing any trade-offs really. Unemployment's below 4%. It's been there since the beginning of the year, despite the fact that we've raised the Fed funds rate over 200 basis points and planning to do more. So the issue is, what's going to happen to unemployment as we keep raising rates and rates say get up to, let's say, 4%. There's been this debate about how much unemployment has to go up to bring inflation down. I've tended to be on the side that because of things like these persistent labor shortages, you're not going to see firms laying off their workers en masse. They work too hard to get these workers. They spend too much time training them to then say, oh, we're going to let them all go en masse because we're going to have a couple of soft quarters of GDP. So I'm hearing that from private sector contacts. They do not intend to have anything like mass layoffs like you might have seen in the past. So that leads me to believe that we can put a lot of pressure on demand, put downward pressure on prices, and it's not going to have a really large effect. Now, that's one possibility. It's not a forecast, but it's kind of my intuition of how things are going to go. So, you know, if unemployment were to stay under, say, 5%, I think we could really be really aggressive on inflation. Once it gets over 5, there's going to be obvious pressure to start making trade-offs. If we don't get inflation down, we're in trouble. Chair Powell said it yesterday. The only way we can have good, healthy labor markets going forward is we've got to get inflation down. So that's the number one job. And we'll just have to do what we have to get that down. Sure. We're okay.
I have a final question. So I respect that you're saying you're not going to comment on other central banks' policy. What about other countries' fiscal policy? So
I definitely don't.
So we are in Europe, and in many European countries these days, you hear the following line of argument. Okay, inflation is too high. The poor can't afford, people across the board cannot afford to pay their living. So we have to engage in fiscal policy and make public payments to the poor, but not only to the poor, also to the middle class, etc., etc. So is that a sensible thing to do, given what you just said?
Like I said, I don't even comment on our own U.S. fiscal policy. I'm sure it's not going to talk about anybody else's fiscal policy. David? Oh, well, Michael, you're a host, so you get to ask a question for sure.
I don't ask central bank, maybe indirect. If inflation seems to be triggered by international prices, particularly import prices, worldwide energy prices, then you can have big differences between, let's say, a PCI and a GDP deflator. So, and then I imagine it's somewhat difficult for a central bank to say, hey, what exactly should we respond to? Should we already respond aggressively if it's only input prices before, let's say, domestic prices go up? What's your point of this? Should central banks move early and aggressively, even if it comes from imports?
Yeah, I mean, I've been making this argument since last, basically February or March, that we needed to aggressively front load rate hikes, get the rate hikes in now before the economy starts to really soften or labor markets really go down, get those things in place. Because the other alternative is you promise them out in the future, but those promises can be broken. But once you've done it, they're data, they're no longer promises. So I've been pushing for a lot of front loading in the US before we get a lot of softening, say in the labor market and GDP, because the economy can take it, right? It seems to me you want to be aggressive with rate hikes when the economy can actually take a punch. And that's what we've been doing for the last 6 months here in the US. Import prices, they come down, that's great, that helps us, right? It's just a question then of how much we have to go up and for how long we stay there. So those are the kind of things we look at to see in the data.
Yes, there's another question from online, Alistair Bull, Bloomberg. Chris, you've mentioned that you don't want to get burned again by a false inflation reading, but Alistair asks, with the run rate of Fed QT hitting full stride this month, and given your view that the hikes will continue at least until early next year, are you getting close to the point where you risk ever tightening or over tightening, I should say? Or is that a risk you're just prepared to take to curb inflation?
Yeah, so on the balance sheet, there's two kind of views on this. One is that all the action happens at the announcement. It all gets priced in because it's a systematic runoff. Markets just price it in right out of the gate. And then after that, it doesn't really have any pricing effects. You're just carrying through on the promise that everybody priced on. The alternative is, look, as you go along, you still got to get people in practice to actually take the stuff off your hands. And that could put some upward pressure on, upward pressure on rates. The critical thing is that when we look at the balance sheet, every estimate that I can see or it's done, and these are rough estimates, is that, something like $1 trillion of runoff is about 25 basis points in terms of a hike. So it's not that big. If you looked at the 10-year when Governor Brainerd gave a speech and kind of laid out what the QT was going to look like, long-term rates jumped to about 38 basis points. So, somewhere between 1 and 2 hikes. But now it's all been priced in. So it's not clear how much more pressure this is going to do on upward rates. We'll start to see it if we start seeing a lot of drainage out of our RP facility. We'll see that reserves are getting pretty scarce, and then you might see some other issues.
I think that's a wrap, Chris. I wanted to say I wanted people online to take a look at the award that was designed by our dear late friend Kirsten Zeiss. And we misspelled his name on purpose. As Chris says, it's Wallner's razor, but we award it each year to the conference's best critic. And in that spirit, we may not always agree with you, Chris, but we will always love you and respect you. Thank you for your public service.
Thank you. Thank you, everyone.